The Nigerian fixed income market saw a mixed quarter in Q2 2024. And today, I would like to discuss these trends and get expert insights on the fixed income market outlook for Q3 2024, particularly focusing on Nigeria. Oladipo Ajayi, Head Fixed Income and Forex, Chapel Hill Denham, joins me for this. Thank you, Oladipo, for joining me today.
Yeah, good morning. Thank you very much for having me on.
Right, let's begin with an overview of the fixed income market in the past quarter and some trends that shaped it.
Well, if you look at where we started at the beginning of the year, we started at the best. 1 year treasury bills actually cleared at the first auction at 8.4%. But don't forget that in the month of February, we had our first MPC meeting after a long time where the new CBN governor actually hiked rate by 400 basis points. And this actually impacted the LTB rate as well. And so also in the month of March, we had another meeting where we also had another 200 basis points, meaning in Q1, we raised rate by about 600 basis points. And we saw the impact on these both on the treasury bill size and also in the Q1. It was a very aggressive quarter for the DMO. The DMO actually issued bond to the tune of 6.4 trillion in Q1, and that is actually very massive because when you compare where we're coming from and where we are now, it's actually a big leap. Because it's actually a tall order, because no one even expected DMO to be able to raise such volume in that short time. But you don't just raise volume, there's a price to pay for it, and the price we paid for it was that rates actually went up. So when you now compare the beginning of the year to where we are now currently, the first 1 year that we said rate actually cleared at 8.4. As we speak, a 1 year paper actually cleared at the last auction that was conducted on Wednesday at 21.24, and that's over 1,300 basis points from where we were before. And to me, I think that rate has moved aggressively from where we used to be, and that's not only on the treasury bill side, it also affected the bond side as well. A 10-year paper was actually trading at around 16% at the beginning of the year. But as we speak currently, the same 10-year paper is currently trading around 21.5, and that is actually about 500 basis points from where we were before. So between January and now, we've seen aggressive move, and that could be attributed to the current policy of the central bank in terms of the aggressive policy. We've seen rates, interest rate move by about 750 basis points between January and now, and we also expect that to actually impact on yield, and that's exactly what has happened in the markets.
Now let's look at the bond market now. It started bullish, then saw some form of wait and see periods before ending with profit taking, that sort of lowered price. I'd like you to just speak to us a bit about this.
Yeah, if you look at where we started, for just like I mentioned, we started at a high price levels, and but when market starts sensing the body language of the central bank, it actually led to more of a time where it was more like a doji period, a period of indecision, a period where you don't know how aggressive the central bank will be, a period where you are still waiting to see whether it's more like it's just a one-off or it's something that is going to be continual. And by the end of the day, when market found out that it's more like a continual exercise on the part of the central bank, because of what we saw in February and March, immediately we start seeing people taking profits in the market, and that actually pushed price down and pushed yield up. As we speak currently, most of the instruments that were trading at premium at the beginning of the year, they are currently trading at deep discount as we speak currently. So for me, I think that this will also be here for a short while more, knowing fully well that the central bank is not currently actually reversing its aggressive policy. The central bank, as we speak currently, is ensuring that there's huge depth of liquidity in the system. And what actually determines our market trade is basically the level of liquidity in the system. So as we speak now, I think yield will continue to be at this level for some time.
Right. For Eurobond markets in Q2 2024, it was sort of marked by cautious stability. I'd like you to talk about the factors that drove that sentiment and what your outlook is for Q3 that's looking at Eurobond, actually.
Yeah, at the beginning of the year, markets were actually expecting what would be the direction of the U.S. Fed, and they came out to say that they will be about 3 rate cuts this year. But what we noticed was that inflation in the United States was not actually dropping. It wasn't coming to the level that the Fed is actually expecting. And as a result of that, the Fed continued to shift goalposts. So in Q1, there was no rate cuts. And so also in Q2, and they came back to say that we may not likely see any rate cut until later in the year. And they put it at more like a minimum of 1. So looking at that body language, it created more like a waiting game for the markets because what determines how the Eurobond market will actually operate, basically more like a spur from the action or inaction of the US Fed. So based on what we are currently have on the table now, the expectation is that there will be rate cut, but it may be later in the year. And market actually now factor that in because if you noticed at the beginning of the year, Nigerian Eurobonds were trading across board on double digits. But when you look at markets currently, the short-dated ones are trading at deep single digits. If you look at the 2025 paper, it's currently trading around 7%. And when you look at the longest paper on our bourse, that's the 2051, it's trading at 10% now. So it tells you to a great extent that markets already factoring the rate cuts into the pricing.
Wow, that means you're expecting rate cut towards the end of the year. So in the meantime, what are your expectations, from the side of the MPC?
Yeah, I think we expect, for me, I've reiterated this severally, that in the month of July, I expect more like the central bank, the monetary policy to actually maintain. This is not a good time for you to further increase rates. We'll be seeing impacts one way or the other. Although inflation has been going up, but more like at a reducing rate now. So it simply means that one way or the other, the aggressive policy of the central bank is yielding. And now that the fiscal policy guys are also waking up to the responsibility before them, I think we'll likely start seeing better results from what the central bank has been doing. So for me, I don't expect any rate hike in the month of July. And also, the central bank governor also said yesterday that we may likely see rate cuts. And so it simply means that the central bank could also cut rate this year. So if the central bank is going to cut rates this year, I feel that it's more like a tall order. But that means that we'll be at the November MPC meeting. And by so doing, by then, that means that inflation would have dropped significantly to actually necessitate that rate cut. But for me, I will actually pitch my tent around the fact that maintaining rates throughout the year so as to ensure that the economy is stabilized and ensure that there's currency stability.
Well, today is 12. I guess by 15 we'll get to know the inflation numbers, and that would probably spur the MPC's action when they meet 22nd and 23rd. Away from that, let's talk about general outlook, for FGN bonds and bills. What's your outlook, and what sentiment do you think will spur that?
Yeah, my outlook is I expect yield to drop, because immediately we start seeing the central bank actually reducing the rates of the aggressiveness to actually mop liquidity from the system. That will also impact yield as well. And if you look at the DMO's calendar for this quarter, it's not as aggressive as what we have seen in the past auction. For this quarter, we are expecting DMO to raise 300 billion on a monthly basis over the quarter. That means that the DMO is expected to raise about 900 billion for this quarter. But now compare that to what we saw in Q1. The DMO raised about 4.8 trillion in Q1 and raised about 1.65 trillion in Q2. So you can see the rates that they've been a bit aggressive in raising debt in the market. and that means that that will actually push yield down. And also, like I mentioned, that the central bank are already saying that there could be likely be a rate cut after we start seeing better impact from their current aggressive policy. So it simply means that the market will also mean that rates should start dropping. So for me, I expect rates to actually drop. So currently in the market, it means that anyone that wants to invest should actually dive into the market as we speak currently. When you see a 10-year instrument yielding 21.5%, I can tell you I've been in this market close to 2 decades, and we've not been here before. We've not been this high before. The highest yield that we have had before now was around 17%. So we actually beat that by over 450 basis points. So it simply means that anyone that has a long-term investment view should quickly jump into the market before rates start dropping aggressively.
Coupon payments are near. Do you see some pockets of cherry picking?
Yeah, of course. Even while the market is actually very, very quiet, we continue to see a portfolio manager coming to the market to cherry pick. On a monthly basis, the PFAs, they receive contributions from their members, and at the end of the day, what that will mean is that they need to actually invest such funds. And we've been seeing them in the market cherry picking instrument across the curve. Also, we have been seeing asset managers also in the market also cherry picking. And also, don't also forget that we've been seeing coupon payments on a monthly basis. And between now and the end of the year, that is if the DMO, assuming that the DMO decides not to issue anything again from now to the end of the year, we are expecting about 1.98 trillion worth of coupon payment. So you expect that to also fuel aggressive purchase in the market when this inflow starts hitting the market. So we expect market to continue to cherry pick while waiting for that signal, for that aggressive move in price.
Right. So what investment opportunities rather should investors target in the local market, especially during this period? And, why do you think they might be attractive? Now, if you're short-term investors, a treasury bills market has put before you the opportunity for investment. When you look at buying a 364-day paper at around 21%, that will give you an effective yield of close to about 27% effective yield. You understand? So imagine you investing in a year and earning 27%. So I think it's a very good one for anyone that actually have short-term fund to invest. But if you're a long-term investor, I want to tell you that investing in like a 10-year bond currently will actually give you that long-term opportunity. So it simply means that you have the opportunity to earn 21% effective return over the 10 years. And when you look at a 10-year, if you smooth out average yield over 10 years in Nigeria market, the average yield will come to around 13% because that looks more like our normal level. It was because of the peculiarity of the time. That's why yield went as high as this. So it comes once in a decade, and anyone that actually can sense that should actually take advantage of the current levels. Oladipo Ajayi, Head Fixed Income and Forex, Chapel Hill Denham. Thank you for your time and your thoughts on the show today.
You're welcome. Thank you very much for having me.